So good afternoon and welcome to this My Money Matters hosted webinar, Understanding the Local Government Pension Scheme. My name is Ian Anderson. I'm one of the financial education coaches at My Money Matters, and I've worked in financial services for over 40 years. And prior to joining My Money Matters, I worked for Prudential for 7 years, Prudential being one of the main providers of ABCs in the local government pension scheme. During that time, I've assisted thousands of members like yourselves in retirement early and or with more money. And today I'm going to give you an overview of some of the key benefits of being a local government member of the pension scheme, and also how your benefits are calculated, and also some of the options you have of enhancing those further. Please note this webinar is for educational purposes only. It doesn't constitute financial advice in any way. The information that I run through this afternoon is based on our current understanding of taxation, legislation and scheme rules. Levels, bases, relief from taxation are subject to change and also treated on an individual basis. And in respect of the investment funds, remember that they can go down as well as up, and past performance of those funds should be seen as an indicator of how they may perform in the future. Now, this webinar may be recorded for training and compliance purposes, which also means that if there's anything you suddenly want to revisit, you're also able to download a copy of the recording after the webinar itself. As we go through this afternoon's webinar, if you want to ask any questions, you can do so by making use of the Q&A feature you'll see at the top right of your screen. Please try and keep any questions that you have in relation to the content that we go through, and also try to avoid sharing any personal details. And what I'll do at the end of the webinar is run through any questions that you have. So this afternoon, we'll be looking at retirement and the local government pension scheme. But in addition to that, we also are doing webinars on other financial aspects, so debt and money management, savings and investment, planning when it comes to your estate and long-term care. Also webinars about insurance and protection. So if there's any of those that you feel that may be helpful in understanding the financial impact of those things in your life, by all means, register and attend any of those webinars that you're able to do so. So what are we going to be looking at this afternoon? So first of all, I'm going to give you an overview of your local government pension scheme and some of the key features and benefits it offers you purely by being a member of it. Some of you may well, no doubt, be aware of some of those features, but it is a really good pension scheme with lots of key factors to take into account. We'll then also have a look at how your local government pension benefits are calculated, which effectively is going to be based on your service within the scheme, which has changed over the years. So some of you may have service in different sections of the local government pension scheme, and try to help you understand what it all means in the bigger picture. Now, as good as the local government pension scheme is, and it is a really great scheme, there always is option to enhance those benefits a little bit further. But what are they, and how do you go about accessing those? We'll then look ahead to that key chapter of your life, your retirement, and ask the question, when can you actually retire, and also some of the things you need to consider when you do so. And finally, if you're not making any form of additional provisions for that key chapter of your life, how do you start the process? Very straightforward indeed, and I'll explain what that looks like. So let's start by taking a look at some of the benefits that being a member of a local government pension scheme offers you. First of all, it is a secure scheme, so you don't have to worry that your pension is not going to be waiting for you when that time comes. So it's through an act of parliament that the government guarantees to pay your pension when you retire. So you don't have to worry about any potential horror stories, but that's not going to be waiting for you. Now, that guaranteed income will be paid to you on a monthly basis. So if you spent your whole working life being paid monthly, the good news is that when you do retire, your pension effectively is going to replace that. Now, that guaranteed income is also paid for life, so it doesn't run out after 15, 20 years. It carries on until the day you die. So again, a really important feature, but you have that peace of mind knowing that that is going to be paid from when you retire to the day you die. Even better still, that increases in line with inflation, so it doesn't remain static. It's measured against the consumer price index, really, which is going to help offset any external inflationary factors. Assuming you're a taxpayer, the good news is that you don't pay tax relief on the contributions that you pay into the local government pension scheme itself. So effectively, you are saving money from the outset. On a more morbid note, you do have a peace of mind that if you were unfortunate to pass away, a death grant of 3 times your pensionable pay is paid to your nominated beneficiary, and a survivor's pension of up to 50% of your pension is paid to your spouse, cohabiting or civil partner, and in certain circumstances, eligible children too. Should never be underestimated how much your employer is contributing towards a local government pension scheme as well. In some instances, it can be as much as 20% of your salary. Now, if you're at that age where maybe you're thinking of slowing down, maybe taking your local government benefits and then returning to employment, maybe on a 2 or 3 day week basis, flexible retirement might seem quite an attractive proposition. However, I would always stress that your employer does not have any contractual obligations to agree to any flexible retirement requests. So if it is something that you're considering, I would always check with your HR team first. Now, if you're ever in a situation whereby money was so tight you actually considered opting out of a local government pension scheme, there is an alternative to that known as the 50-50 section, whereby you pay 50% of the amount into the pension and you get 50% of the pension built up. Now, this enables you to retain any ill health or life cover benefits. Talking of ill health, you also have the peace of mind knowing that if you were unfortunate not to be able to work through ill health, your local government pension does have protection. Now, this does require 2 years membership in the scheme itself and is also subject to medical confirmation. And anyone with long service in the scheme, so if you have service before April 2009, the good news for you is that as well as receiving an index-linked pay for life pension when you retire, you'll also receive a tax-free cash lump sum as well. So when you look at all those benefits, you can see it's a really great scheme. But have you considered how your pension is calculated, what it may look like, and probably most important of all, whether that's going to be sufficient to do the things that you want to do when you retire? Now, all of you today will be members of the care section of the local government pension scheme, the career average revalued earnings section, which came into force on the 1st of April 2015. Now, how the current section of a local government pension scheme works is for every year, 1/49th of your current salary is banked as pensionable income. So, for example, if you earn £49,000 a year, £1,000 will be banked towards your pension. If you earn £24,500, £500 will be banked towards your pension. So every year, 1/49th of your salary at that time is banked towards your pension. Now, that pension is measured against the consumer price index, so it ensures that it's not adversely impacted by any external inflationary measures, so that will grow over time. And when you come to retirement, all of those 1/49th index-linked payments go towards your annual pension at retirement. Now, prior to the current care section, there was another section of the local government pension scheme, a final salary one, which ran from the 1st of April 2009 up until the 31st of March 2015. Now, this works differently to the previous care section, which I mentioned, which is your current local government pension scheme section, because this previous section is based on your final salary, not your current salary. So how the section from April 2009 up until end of March 2015 works is for every year's membership within it, 1/60th of your final salary, i.e. the salary that you retire on, is multiplied by those number of years, and that determines another segment of pension which will go towards your total income at retirement. So, for example, if you worked for a full 6 years during that section of the scheme, that will equate to 6/60ths of your final salary going towards your annual pension at retirement. And prior to that, there was another final salary section of the local government pension scheme, which ran up until the 31st of March 2009. Works exactly the same way as the 60th, although not quite as generous insofar as for every year's membership, 1/80th of your final salary is banked towards your pension at retirement. And in addition to that, as I mentioned earlier, if you have membership in that 80th final salary section, as well as receiving a pension, you'll also get an automatic tax-free cash lump sum as well. Now, obviously, if you only join local government after April 2015, then your retirement benefits are purely going to be made up of the current care section. However, if you have membership prior to that, you will see on your local government pension scheme statement those different sections broken down accordingly. And it's the amalgamation of those different sections which gives you your total income at retirement. Now, one of the other things which also would have changed when the current care section come in was your normal pension age. So prior to April 2015, your normal pension age would have been 65. However, when the care section come in, that changed from being 65 or your state pension age, whichever is the higher of the two. So for some of you, that may be 66, maybe 67, even 68, effectively meaning that you're going to have to work longer if you don't want to incur a reduction to your pension. And as I say, most people generally want to retire before that normal pension age. So when can you retire? Well, currently, the earliest anyone can access any pensions is from the age of 55. Now, that is due to change to 57 in April 2028. So depending on your current age, it may well be that 57 would be the earliest you can access any pensions. Now, for every year you want to retire before the normal pension age, there will be reductions. You can go on to your main local government pension portal and get a projection to your desired retirement age if you want to retire before the normal one. The pension will obviously be reduced, so you can get an idea of what impact that may have should you decide to retire early. Now, there are certain situations whereby that reduction may not apply. So, for example, if you had to retire through ill health, as I mentioned earlier, if you're made redundant due to business efficiency reasons, or if you have long service in the scheme and a combination of your age and your service means you qualify for the rule of 85. Now, you can get further details on that on your main LGPS members website. So just to demonstrate the potential impact of retiring early can have, this is Sarah. Now, Sarah has a normal retirement age of 67 at that point. Her projected local government pension is determined to be £14,277. Now, because Sarah has membership in that final salary section, the 80ths, which ran up to April 2009, she's also going to receive a tax-free lump sum of £1,106 too. However, if Sarah goes at 64, she is not going to receive that amount because, first of all, there's going to be two reasons why her pension is going to be reduced. First of all, she's going to have 3 years less contributions going towards it. So effectively 349 based on the current care section. And because she's taken it before her normal pension age of 67, there's also going to be some form of actuarial reduction to it as well. But if she went at 64, she would find that a pension dropped to £10,253 a year and also see a slight reduction in that lump sum too, leaving a difference of over £4,000. So again, you'll see that there can be quite a significant impact by retiring early. And remember that difference of £4,000 isn't just at 67 when Sarah takes her local government pension. It's for every year that she lives into her retirement because your local government pension is index linked and it's paid for life. So if Sarah lives 20 years into her retirement, I'm sure you get an idea of the cumulative impact of that reduction. Now, generally, we don't save enough for retirement at a time when people are living longer. So that's why it's really key to ensure that you have sufficient income for that key chapter of your life. So what other options do you have in terms of boosting your retirement income? Well, one of the options you have is additional pension contributions, whereby you are buying more local government pension from your main scheme. You will get tax relief on that amount, the additional pension that you purchase. You can purchase it by way of a lump sum, and any tax relief you have to claim back from HMRC, or you can make the repayment of that purchase through your salary each month over a fixed amount of time. And any tax relief would then be done automatically by your payroll. Now, you can purchase a maximum of £7,294 of annual pension. There is a calculator, again, on your main LGPS portal where you can get an idea of what the cost to you will be. That additional pension will increase in line with inflation. So you do have that reassurance to know that it will increase over time. However, you don't have any flexibility around the payments if you're making them each month. And now the cost of that payment effectively is going to depend on a number of factors. It's going to depend on your age, your sex, and how long between now and when you're looking to retire. Generally, the shorter the repayment period, the higher those premiums. Generally, you would have to live around 14 years into retirement to recoup the outlay of additional pension contributions. So that doesn't tend to be a huge uptake of them, as they tend to be quite expensive. The other thing also to bear in mind is that if you were unfortunate to pass away before retirement, any additional pension that you purchase would die with you. It would not go to your nominated beneficiary. So again, another key factor to consider. Now, whatever pension scheme you belong to currently in the UK, you're allowed to take up to 25% of the value of those benefits as a tax-free cash lump sum, certainly much more than what was allowed previously. And any of you who do have membership in that final salary section, the ATFs, before April 2009, the lump sum that you're going to be receiving is unlikely to get anywhere near the maximum that you're allowed to have. So how to get more tax-free cash? We do have an option at retirement to exchange some of your pension for tax-free cash. The way it works in local government is on an exchange rate or commutation rate of 1 to 12. So for every £1 of pension you give up, you'll get £12 of tax-free cash. So if you choose to give up £2,000 of your annual pension, it means you've got £24,000 in return. Now that might seem very appealing. After all, who doesn't like tax-free cash? And invariably, when you look at your local government pension scheme statement, you'll see what your standard benefits are projected to your normal pension age based on your service within the scheme. And you'll also see the option of taking a maximum 25% lump sum instead. Now, I understand why people's eyes might light up when they see that figure, but you'll also notice that your local government pension has been reduced significantly. And also, if you're one to retire before your normal pension age, that reduction is going to be even further. So wouldn't it be great, actually, if you had an opportunity whereby you can take as much pension as you possibly can and as much tax-free cash as you can, but not by reducing your valuable index-linked pension? So you could see the employee benefit, but you also have at your disposal the shared cost AVC as the means to do so, effectively the best of both worlds. So what the AVC is doing is building up a pot of money in a tax-efficient way that you can potentially take back completely tax-free at retirement. That's worth noting, the local government pension scheme is the only public sector pension scheme that not only allows you to save in this way, but gives you the option of taking the AVC back completely tax-free. So members of the teachers' pension scheme, NHS, for example, they don't have this option that you have. There are a couple of caveats to taking the AVC tax-free. One is that you take it at the same time as you take your local government pension, whatever age that may be. And also there's a limit to how much tax-free cash you can take. Now, if you don't know what that limit is, don't worry too much. I'll explain how we can always help you calculate what that is. Now, one of the great features of the AVC is its flexibility. So unlike additional pension contributions where it's a fixed amount, you can change the contributions into the AVC up or down anytime you'd like. So if your car suddenly needs repaired, you need to go and get that fixed, you can reduce your contributions down to as little as £2 a month and then pick them up the following month. It really is that straightforward and easy to amend. Now, whilst all local government employees paying into the main local government pension scheme have the option of paying additional voluntary contributions, not every local government employer offers additional voluntary contributions on a shared cost basis. So the fact that your employer does is great news for you, because it means not only do you get tax relief on your contributions, as you would with the standard AVC, but also save on national insurance too. So effectively a double tax break. It doesn't really get much better than that. Let's look at an example just to demonstrate the potential savings. So if you wanted to pay £250 a month into a shared cost AVC, and you're an intermediate rate taxpayer in Scotland paying 20% tax, what would that actually cost you from your take-home pay? Well, it would actually cost you just over £178. So that saving that you're making every month is purely from the tax and national insurance. So that saving of nearly £72 a month is from the tax and NI savings you make, which effectively equates to a return of nearly 40%. So when you compare that to other forms of savings, such as the NISA, such as the Building Society, can't you see it compares very favourably indeed? Yes, you could access any of those other options anytime you like. With the AVC, as I mentioned earlier, the earliest you currently be able to do so would be from the age of 55. But remember, this isn't putting money aside for next year's holiday. This is putting money aside for hopefully the longest, the most enjoyable holiday of your life, your retirement. So if you see this for what it is, a fantastic opportunity to save in a tax efficient way and give yourself more options, come at chapter of your life. How do you start the process? Quite simply, just go to the My Money Matters website and complete the application form there. So enter your personal details, and from the investment company for your employer, decide from the fund guide where you want that money invested. Your employer will then verify the application, make sure everything is in order, and you'll also be able to set up an online account with the provider too. And participation in the scheme itself will take effect from the next available payroll. Now, if you're already making AVC contributions, or once you establish your AVC, again, it's very easy to amend. You just log in on the My Money Matters website, head to the My Shared Cost AVC page, and simply enter the new amount. It really is that straightforward. And once your application has been verified, again, it will take effect from the next available payroll. Now, I'll come on to any questions shortly, so if you do have any final questions, now is your last call to ask away. Now, I appreciate sometimes people might just want a little bit of assistance or dot the I's and cross the T's to see what scope they have in taking advantage of this employee benefit and opportunity. One of the ways which we can help you do that is by offering you a one-to-one meeting via Microsoft Teams. So what we can do at that meeting, based on your service in the scheme, is calculate the maximum AVC you could potentially take back tax-free as a cash lump sum. Based on your salary, see what the maximum amount you could pay in any 1 month, the figure which will keep your salary above the national living wage, to really help you get the most out of this fantastic scheme. Now, we can't give you any financial investment advice. We can talk you through those investment options to help you put yourself in an informed position, but ultimately we can't recommend or advise. Now, all you need for that meeting is your most recent local government pension scheme statement or a projection to your chosen retirement age. If you have an AVC, currently have an understanding of how much is in that pot at the moment, and please have your most recent payslip. Now, if you need any further assistance after today, what does that look like? So effectively, you can go to email us at support@mymoneymatters.co.uk if you have any queries. And also on the website, during working hours, you can use the live chat facility too. So if you're completing the application when we get stuck, something you're not quite sure about, you can use that live chat facility. Similarly, during working hours, pick up the phone and dial the number shown and speak to our friendly customer services team. Do go to the Knowledge Hub on my website. Why? A couple of reasons. First of all, there's a really useful calculator on there that you can play around with. So effectively, you put your salary in, how much you're thinking of paying in, and when you're looking to retire, it will do 2 things for you. First of all, it will tell you the cost to you from your take-home pay for that contribution, and also give you an idea of what you could potentially build up in the AVC between now and retirement. Very easy to use, but also very powerful and seeing the potential scope that this opportunity gives you. Now, if you have any queries about the ABC, so pretty much any question that anybody has ever asked, you can go onto the website and download the PDF document, which will cover all the frequently asked questions. So just follow the link to FAQs, click on the link, and it will download that PDF document. And that will cover pretty much any question anybody has ever asked. What about this? What happens to that? And that will be bespoke to your individual employer. Okay, can't see any questions come through, which is absolutely fine. If there is anything subsequently, by all means, get in touch as you so choose. Now, as I say, local government pension scheme is a really great scheme. Hopefully you've seen today that it has some really key benefits and features. However, as good as a local government pension scheme is, there's always that option to increase those benefits further. And this is a fantastic opportunity to do so. But as in most things in life, the best opportunities only fulfill themselves to their fullest extent if you take advantage of them. Thanks very much for listening to me this afternoon. I hope you have the rest of a pleasant Thursday.